Welcome to Morphic Labs, and today we are going to be discussing the retail quant structural edge, a mathematical analysis of the capacity constraint and a nimble trade advantage. We are going to be diving into chapter 4, the retail opportunity space, but before we get into that, do me a favor, hit the subscribe button if you want to keep up with more content like this, and if you're interested in increasing your market intelligence, I have a free market microstructure and trading systems course that will walk you through the foundations of market structure, the mechanics of trading, market data, and analytics. Plus, a free advanced market aggregation course that walks you through advanced price aggregation, volatility-driven aggregation, information-driven aggregation, order flow and microstructure aggregation, event-driven and hybrid method aggregation, implementation, and selection criteria. If you're interested, the link's in the description. You just gotta sign up to be a free member. If you do, pretty cool. If you don't, whatever. Let's get into it. The retail opportunity space. Micro-alpha exploitation. The structural constraints on institutions create a rich opportunity space for retail quant. Strategies that are economically unviable for large funds can deliver exceptional risk-adjusted returns for small accounts. Definition 4.1 Micro-alpha. Anomaly generated excess returns that exist in markets or instruments with insufficient liquidity to absorb institutional capital, but which provide meaningful absolute returns for accounts below the capacity threshold. Table 7 Micro-alpha strategy categories and their constraints. Strategy category typical annual return max capacity why institutions avoid it is going to be our 4 columns. When you look at small cap statistical arbitrage, it has a typical annual return of 20% to 60%, max capacity of 2 million to 10 million, and institutions avoid it because of their market impact in this particular uh, instrument is going to be much greater than their alpha. Niche crypto pair trading has a typical annual return of 30% to 100%, max capacity of 500k to 5 million, and institutions avoid it because it has insufficient average daily volume. Options microstructure spreads, typical annual return 15% to 40%, max capacity 1 million to 20 million, and institutions avoid it because of position limits and wide spreads that will eat them alive. Cross exchange arbitrage, typical annual return 10% to 50%, max capacity 100k to 2 million, and institutions avoid it because of capital constraints and tech costs. Intraday mean reversion 25% to 80% is the typical annual return, max capacity of 500k to 5 million, and institutions avoid it because of slippage dominating at a large scale. IPO secondary opening has a typical annual return of 15% to 35%, max capacity of 1 million to 10 million, and institutions avoid it because of allocation limits and competition. 4.2 The invisibility premium. The retail quant's most powerful advantage is invisibility. When an order represents less than 0.01% of the order book depth, it executes without trace, without signal, and without triggering predatory algorithms. Proposition 4.1 The invisibility threshold. A trader is invisible in the order book when their order size Q satisfies Q is less than Q sub invisible equals min of Q sub depth times epsilon times ADV over 10,000, where epsilon is the detection threshold of HFT systems. Typically, epsilon is approximate to 0.05, and V sub ADV is the average daily volume. For a typical small cap stock with Q sub depth approximate to 50,000 and V sub ADV approximate to 5 million, the invisibility threshold is approximately Q sub invisible is approximate to 2,500. Table 8 Invisibility threshold by asset class. We have asset class, typical book depth, detection threshold, invisible, order size, retail can be invisible as our columns. And you see large cap equity has a typical book depth of 500k to 5 million, has a detection threshold of 25k to 250k. Invisible order size has to be less than 25k. Retail can be invisible, yes. Mid cap equity, typical book depth of 50k to 500k, detection threshold 2.5k to 25k. Invisible order size has to be less than 2.5k. Retail can be invisible, yes. Small cap equity, typical book depth 5k to 50k, detection threshold to 250 up until 2.5k. Invisible order size has to be less than 250. Retail can be invisible, yes. Major crypto 1 million to 500 million is the typical book depth, detection threshold 50k to 2.5 million, and invisible order size has to be less than 50k, and retail can be invisible, yes. Alternative coin 10k to 500k, detection threshold 500 to 25k, invisible order size has to be less than 500, and retail can be invisible, yes. Options liquid 50K to 200K, detection threshold 2.5K to 10K, invisible order size has to be less than 2.5K, and a retailer can be invisible given only 1 to 2 contracts. 4.3. Holding period and alpha decay. Alpha decay, the erosion of predictive signal over time, favors the retail quant who can execute instantly. The institutional requirement to spread execution over hours or days means they capture a degraded version of the same signal. Alpha of t equals alpha sub 0 times e to the negative lambda times t plus sigma sub alpha times w of t, where alpha sub 0 is the initial alpha, lambda is the decay rate, and w of t is the Wiener process capturing stochastic decay. For high-frequency signals, lambda can exceed 10 per hour. Table 9, alpha retention by execution speed. Signal type, decay rate, lambda, retail 1 second, retention, institution 1 hour, retention, institution 1 day, retention. Now, ultra-high frequency arbitrage at decay rate of 30 per hour and retail retention at 1 second is 99.2%. And an institution at 1 hour has a retention of 0%. And an institution at 1 day has a retention of 0%. High frequency momentum, decay rate 10 per hour. Retail at 1 second retention can retain 99.7%. An institution at 1 hour retention can only retain 0.05%. An institution at 1 hour retention can only retain 0%. Intraday reversion 2 per hour. Retail at 1 second 99.9% retention. An institution at 1 hour retention about 13.5%. And an institution with 1 day retention about 0%. Daily mean reversion, a decay rate of 0.5 per hour, and a retail retention at 1 second of 99.9%. An institution with 1 hour retention has a 60.7% retention, and an institution at 1 day retention has 0.01%. Slow momentum, 0.05 per hour. A retail at 1 second retention has about 99.9% retention. An institution at 1 hour retention has about 95.1% retention. And an institution at 1 day retention has about 30.1% retention. But that's about it for today. On the next video, we'll be diving into the quantitative framework and the nimble edge. But that's about it for today. If you're interested in increasing your market intelligence, I have a free market microstructure and trading systems course, plus an advanced market aggregation course. The links in the description, they're both basically free. If you sign up to be a free member, and hit the subscribe button if you want to keep up with more content like this, and I am out. Bye.